Hi, I'm in central London with a group of investors. We're talking about commercial property, and we're talking about getting into it. We're talking about how to, where the greatest opportunity is in commercial property in this video. We're answering a whole set of questions. If you're new to the channel, make sure you subscribe. We publish 3 pieces of brand new videos each and every week, and they're all dedicated to helping you be more successful in property. So let's just dive into it. Veronica, you've got a question.
Yes, my question is about investing in commercial property, most specifically in retail. The high street feels like a pretty scary place to invest at the moment. So what would be your thinking around that?
Yes, I think the thinking around it is, I've been doing property for 30 years, and whatever's scary, what you've got to do is dig beneath the headlines and figure out where the opportunity is. And behind every scary headline, there's opportunity. Now, what I mean by headlines is the press is going to lead on the downside of retail. And there is some major downside in retail. Firstly, some shops are just very hard to do anything with. If you think of BHS stores, Debenhams, they're very hard to repurpose because they're vast, they've got very few windows, they're deep. They were made for selling products off shelves. And now we're doing that through the internet. So the headlines are dominated with that sort of stuff. Now, what the headlines are not really talking about are the shops that are easy to repurpose to other uses or part convert to residential uses. Now, if we look at another area where there are going to be a lot of empty shops, is betting shops, for example. There have been massive changes in betting regulations, and those are going to close down. A lot of them are going to close down. Now, if you look at the average betting shop and compare it in your mind to a BHS store, it's quite easy to see that most of those betting shops are relatively small. You've got a couple of flats you can make in the upper floors with permitted development. Perhaps you can cut down the shop and make a flat at the back. And perhaps you've then got a smaller shop that, provided you've got footfall, will appeal to service sector businesses. Because you can't cut your hair on the internet, you can't have a coffee on the internet, you're still reliant on those sort of service sector businesses. And the other thing that's happening, it's already happening big time, is that more people are living in and off the high street. And as more people live there, because of various resi conversions, there's more of a need for more local shops, which are not necessarily selling stuff that you would get from the internet, if that makes sense, yeah? So it's going through a massive period of transition, and what you're finding, I mean, I love former bank buildings, for example, because they're so easy. First of all, they're beautiful. They often have a little bit of stone in them. They often occupy major sections of a high street. They're in areas of good footfall. They convert very well to restaurants. The upper parts make lovely flats and all the rest of it. Very, very easy to repurpose. So the headlines focus on either the large stores, which are very hard to do anything with, or desolate areas. I would find it very hard to repurpose a retail unit in Hull. There's nothing happening. There has to be a level of affluence in the area. And my rule of thumb is simple. What's the national house price average? It's about 240 grand. So if in the immediate catchment area to your commercial property, you've got the average house price being at the national average or above, then there's a good chance that you're going to find commercial occupiers for that unit. Does that make sense? If you're dealing with an area where the average house price is 40 grand, then there's only so much fried chicken you can have on one parade. It's just not going to happen, yeah? So, we do a lot of retail. We don't have any voids. They're all in areas where there's occupier demand, and it's particularly because we're picking areas where the average house price is much higher than the national average. If you know what you're doing, things are not scary, and that's the time to have fun, because everyone else is just unnaturally scared. I mean, do you feel a little bit less scared?
Yes, a little bit. I can see where that maybe permitted development in the uppers, etc., like that. So that there are opportunities, but as you say, I think you have to be very choosy, and the types of businesses that you put in, that you expect to put in the high street.
Absolutely. I mean, we covered a little bit when I answered this one.
Okay, the question I had was on residential renovations, because you can create value by buying below market value or doing renovations. So I just wanted to understand, in all the gamut of renovations you can do, which ones add more value, so that we're not focused on renovating what you're not going to recover money and make profit on top of that?
Yes. The biggest bang for buck is converting commercial space into residential space. Because what you find is the value per square foot of residential space is nearly double what the commercial value is per square foot. And that is particularly true in shops. Now, I've got a video on YouTube where Kieran Gills bought her first commercial property in West Ealing. She bought it at auction. It's exactly the sort of things we talked about. It's a ground floor shop, and she's used the permitted development strategy to convert the rear of the shop into a flat. Now, if you take and I'll put a link to the video on the top of the screen here, but if you take a typical shop, which is rather narrow but very deep, the rear of the shop is not actually worth that much in commercial terms. And the way commercial values work, rental values work, is rent per square foot. So the front part of the shop is the highest rent per square foot. And then as you go further back, the rent per square foot drops. So commercial property rents are valued by a zoning system. So normally the first third of a shop is Zone A rents, the next third is Zone B, and that is normally half of the Zone A rent. And the last third is Zone C, which is normally half of the Zone B rent. So if you take a rear of a shop, this is what's so magic about this. If you take a rear of a shop, you're talking about space per square foot that rents at a third of the rent of the front of the shop, and you're converting it to residential use. And guess what? In most areas, residential rents per square foot are roughly the same as commercial rent Zone A's per square foot. So if by magic you're turning the rental value of that property into all Zone A commercial rents. So in the video with Kieran, and the reason why it's titled No Money Down Commercial Conversion is because that value uplift from converting commercial to residential space allows you to do the whole deal with no money left in the deal at all. Because the minute you take commercial space to the rear of a shop, which is pretty much dead space, and in an area like West Ealing, convert that dead space into a 350 grand flat, it's quite easy to see how you have literally made something out of nothing. So with commercial property, the renovation opportunity is quite simple. To part convert low yielding parts of that commercial space into residential space. So and what people tend to do, or what I advise people to do, is keep the front part of the shop as a shop. Because it's nice to have a diversified portfolio. There's plenty of demand for smallish shops. You'll rent it.
Okay, so I'm a trustee of my own SAS pension, which business owners can have, and I understand you can own and hold commercial property in a SAS. So it's just, again, any general tips and ideas around that?
Yes, and this is where, really that follows on from the last point, which is the most efficient SAS strategy. SASs and pensions have certain rules, and basically it works best if you buy into your pension a fully baked loaf of bread. So in other words, a commercial property that's already tenanted with a lease on it, that's what your pension's buying. So if you combine that with what we discussed earlier about the renovation, like with the Kieran's shop and making the back part into a flat example, if you do that, say, you've got a flat at the back which you can sell or rent out. it doesn't matter which. This pension, of course, can only buy the commercial element. But once you have rented out the shop to a tenant, you've then upped the value of that commercial space to the maximum it can be, because your pension will value it up at around 6.5% yield. So then the best way to play commercial property with pensions is to do the developments in your own company, like that shop with the flat back in the back, make a smaller shop at the front, do that in your own personal company. And then when the shop is done and rented out, sell that shop to your pension. Because then you've basically extracted money out of your pension in the most tax efficient manner. Because remember, you've got generous tax breaks for putting money in the pension in the first place, and you're making it buy the property off you. All properties that my pension owns have been properties that we've built. So we've bought the freehold, we've made residential bits here and there, we've made a smaller commercial component, we've got it tenanted, and then sold it to the pension for the maximum you can, and that kind of brings money back into your pot, which means that you've got very little money tied up in the whole deal.
So you're presumably splitting the title at some point?
Yes, of course, yes. But the other little nugget is that if you're doing the development in a development company, when you make your development profit from selling the commercial element to the pension, that profit can be contributed back to the pension as part of your company contributions. So it's a lovely cycle of playing this magical game of commercial property and making the figures really work for you. So you can do it in the simple way. You can go out and spend your pension money and buy a property at auction. It's rented out for 6% yield and all of that. But this is far more cleverer and joined up, if that makes sense. But no, when you add all this together, I mean, the power of commercial property is not taking any one, and there was a little bit about this in Colin's talk today, when he was talking about one permitted development right, and then using another permitted development right afterwards, and then perhaps a planning permission right at the end. You know, it's the same with anything you do with commercial property. It's putting all this together to make something quite creative, which can be unique for one deal. I mean, there are many of these things where I've only done once, because no other situation has come up that has had the same set of circumstances. But it's knowing the possibilities of what you can do and knowing how you can mix them up to create an opportunity that other people haven't seen. And that's where you win the deal and do it. It really is as simple as that.
Hi Ranjan. So just keeping on the whole SaaS front here, I'm thinking you obviously take investors' money and do whatever you do with it. So what would you say to convince us that rather than trying to do this ourselves, we're best to come to you and do it through you?
We should all be lenders, because when you are a lender, you know how to pitch for finance when you want to borrow. You know, now I'm an employer and I interview people for jobs. I feel I know what to say if I was going for a job interview, what to say, because I understand what the person at the other side of the desk wants. Now, when you have a SaaS, a lot of people will tell you, oh, you can lend to your own company and all of that. It's not worth the hassle in my view, forget it. You know, there's so many rules, it just overcomplicates things. But what you can do through your SaaS is lend to another property investor. So the people I work with on my mastermind programs and stuff like that, in their own businesses, they're pitching for finance. But when they run their pension, I encourage them to lend. So, you know, you might lend to my business, because it's easier to lend to a business that's not connected to you. But then you instinctively know how, if you're lending me 20 grand on a project from your SaaS, when you are looking for money in your property company, you know exactly how to pitch it. Because I can give you 5 points for how to pitch a deal to an investor, but it'll only click when it's your own money and you're lending it, because you just instinctively start to click on what you need to sort of have. So I advise people, the best borrowers are people who also lend, You know how to wear both hats, you know what to say, and you know what makes a great deal. Now, in terms of when I take I don't do too much of that. I do a little bit of that, but the things with the deals that I do, the numbers are exceptionally compelling, and I find the numbers are compelling. Like I mentioned Kieran's deal, our company has backed that deal. Now, because she's learnt the strategy off me from one of her workshops. Of course I believe in the strategy. The numbers are just plain and simple to see. You take something in West Ealing, more or less a valueless space behind a shop. I mean, she bought the property for $240. Just the flat alone that she'll make at the back is going to be worth about $350. So you don't have to be a rocket science and give tons of spreadsheets to figure out what the value uplift is. And it's not being done with planning permission, it's done with permitted development. So you know when you're buying it, you have the right that no one can take away from you to develop it in the way that you're going to do it. So it's a pretty, the propositions that I get people to sort of fund and come in with me on, and the ones that I lend on, are very clear cut. It shouldn't take more than 5 minutes for you to buy into the vision. And then it's just the due diligence, the numbers, charge, security, all that other stuff. But it shouldn't take more than 5 minutes to buy into the vision of the deal.
The second question I had, I know there's no rule of thumb, but is there any advice in terms of when you do these conversions or renovations, what's for every pound invested, what you should reasonably expect to make on top of it? And just for us to know that if we run the numbers and you're not getting somewhere near there, that may not be feasible?
Okay, not really in that way, because what you're asking me really for is how much do you spend, how much uplift do you get. That often depends on what PD opportunities you're combining together, because every scheme is completely different. But I will say one thing though, is it does depend on you will find plenty of shops in low value areas where the upper floors are just empty. And there's usually a reason why. Because if a flat is only worth 40k, wherever you are in the country, kitchens from Howdens are the same price. So it's going to cost you 50 grand to make a flat with all the soundproofing and all of that. So if it's only worth 40, 45, it's not worth converting. So that's why there are places up north where the value of the end product is less than the conversion cost, so people just leave that space empty. So you've really got to do this stuff where the rule of thumb, I feel, is that it's a national house price average. It's rough. If it's going to cost 50 grand to do a flat, you really need end values to be 200 grand upwards to make it worthwhile. Do remember that commercial property converted into flats are likely to be 10-15% less than a similar sized spec flat in a residential side road, because it's a slight compromise. But as long as it's a couple of $100 grand or so, it becomes really comfortable, and it also makes a great first deal, because when you're doing your first deal, you're not going to get it right. Things are not going to be project managed to their best because you don't have a team in place and all the rest of it, of people that have worked for you on many deals. But you've got the cushion of profitability to kind of make it work while learn very well for the next deal. So yes, it's a great strategy, but you've got to be careful where you peddle it. And that's all down to end values. It's very sad because I have people come to me all the time. I found this place in Dudley or whatever, and there's 2 floors above a shop, and they're completely empty, and they've been empty for 20 years. Well, the price in the side streets is 45 grand for a flat. It's uneconomic to convert, soundproof, all the rest of it. It's just completely uneconomic.
So I'm interested in what would be the evaluation on an HMO that's going from a C1 class to a C4.
Yes. So this is an HMO conversion with planning permission, is it? So the number of rooms?
It's going from a 10 to a 9 bed, so it's been a hotel. So it's going 10 bed hotel to a 9 bed HMO.
Okay. Now the first thing to say about that is the sort of property that will be valued on a commercial basis. The problem that most people run into is that they're just looking at a 3-bed semi-house or whatever, and they've converted it into 5 rooms, and they're saying, we're getting all this rent. Oh, commercial valuation. No, that will be done on a comparable basis. The general rule of thumb is if planning permission was sought for that to be a HMO, that usually is, well, that is required if it's more than 6 rooms, 6 or more rooms. So if you're doing a larger HMO, then that is less like a family house. Yeah, so that can be valued on a commercial basis. Now, there are various valuation, I mean, have you tried to value one or get a loan on? Oh, go on.
So looking at the area, I've been doing evaluation, sort of comparisons, comparable of what the market rents are to rent, as well as comparable in terms of a hotel, because it's quite hard to find a 9-bed house unless it's a mansion and it's further out.
Okay, what a commercial valuation will do is they'll say 9 rooms, £500 a room, £4,500 a month, whatever that is a year, and they will value it based on a yield basis. And then it's down to what yield percentage the lender is happy with. And that depends on the area, the type of tenancy you've got, and the lender. But it can be anywhere between 5 or even 8%, but that varies a lot. But because remember, when you've got 9 rooms and you're valuing it on a commercial basis, you're delinking it from bricks and mortar comparables, and you're just doing it based on the rent roll. Now there are some people who combine this sort of strategy with some kind of social housing strategy. So if you've got, say, the 9-room HMO, and you rent out the whole lot on a 5 or 7 year lease to a housing association, that gives you a great income stream and a great commercial covenant and a great lending valuation. Now the only downside is, like, the maximum any housing association will tend to do is about a 7-year lease. So if you went to a commercial bank, they're likely to say, we'll give you a 7-year loan. But that's not so much of a problem, because you've just got to think, well, in 7 years' time I can either sell it to someone else, or I'll get another extended tenancy and renew the facility. You have to take that risk. But you can get some very good lending on those sort of opportunities if you've got one contract, say with a housing association, and it's a lot easier to manage, no dealing with the residential HMO tenants and all of that. That's a very good way to mix the two. Yeah.
So I'm looking down the professional route, only professionals to rent to, not so much going down the DHS route, where obviously local authorities would be putting that, going down that way.
Yes, I mean, no, just to sort of be clear, what I meant by the social housing route is you would rent the whole building to the housing association for 7 years. You wouldn't have to touch it. You just get the rent every quarter based on full occupancy. You don't have to worry about tenant changeover, repainting the rooms when it gets tatty, fixing a broken wardrobe, dealing with tenancy issues with the communal areas because someone's nicked someone's cheese from the fridge. I mean, every problem you have to, people nick my soap, people come down and make their breakfast naked. Can you stop them from doing that? You get involved in all these tenancy issues under the sun. If you want to do that, that's fine. This is the social way. As long as you don't manage the individual tenancies and you rent the whole lot, can not only be cleaner because it frees your mind space to do the next deal, but you'll get a better commercial valuation and you'll get more money out because the bank will take into account that you got no void and you got no management cost.
So my next question on that would be, the whole idea of doing an HMO and going down and working with local authorities and then putting in their people that they want to put into it, isn't that giving the HMO a bad rep on terms of a lot of landlords have let their properties go? And wouldn't it come across that actually by renting out your place to a housing trust that possibly that could happen to your property, so then it becomes another property that basically has got a bad sort of name against it?
No, I don't believe so. I'll tell you why. Because the housing association is then the landlord. The housing association is responsible for everything. And guess what? There's a lovely bit of legislation. Housing associations, local authorities are exempt from all the HMO licensing and all the housing standards legislation that we are liable for. So they don't have that element of cost. If they take it off you, it's their property for 7 years. You're out the picture. You know, they will run it how they'll run it. And they'll be responsible for the licensing, and it's not on your shoulders. You know, increasingly now with, you know, you've got to make sure your paperwork is served in the proper way. If one document isn't given to them on the day they start their tenancy and all of this, and right to rent checks, you don't have to bother about that. The housing association do it, and guess what? They're exempt from a lot of the rules that we have to follow. So let them do it how they like. It's not. You can then concentrate on the next deal. We talked a little bit about 2020 and the next few years in property and all of this. You know, the market is going to be subdued. These are always times when you can have some fun and really create long-term wealth for a generation. So what you do in the next 3 or 4 years is going to be more important than what you do in the subsequent 4 years. Like really, what I did between 2009 to 2013, 2014, whatever I've done in 2014 to now has not matched that period, because it was such a low point and there was so much opportunity for value creation. And that's what we're entering into now. And when you have that phase, what you want to do is do deals quickly. You want to acquire the asset, develop the asset as quickly as possible, and that means permitted development. Keep it so that you keep the capital gain, but get shot of it from a management headache point of view as quickly as possible so you can go on to the next one. And it's as many of those that you can do in this next 3 or 4 years, because that's going to be, you're going to look back on that and think, I wish I'd done more during these few years.
Thank you.
Any more? We've got more time. Oh, go on then.
Thank you. I had a question in terms of when people say, I want to refinance to get cash out of...
Oh, yes.
Yes, that's the one. So can you please explain what that term actually means in terms of what the process is and what that actually entails, please?
Okay. This is, again, this links on from the last question on the current market. The market ain't moving up. So if you haven't got unlimited funds available, you're going to run out of money after 2 or 3 deals. So it is essential that you get your money out of every deal that you do. So how do you do that in a market that isn't rising? You have to buy well through below market value, and you have to redevelop quickly. That's permitted development, commercial conversions. Now, once you have done that, you've increased the value of that asset, even if the market's not going up. Because if you've created, say, 2 flats where before there was just dead commercial space, you've created real value in, regardless of the market going up, or even if the market's flat. Even if the market goes down, you've created value. So then what you do is you refinance that asset against its new value. So if you've bought something for 100 grand, and you have done some residential conversion and you've made it worth 180 grand, you can then refinance 60% to 180 grand. And then if you then make enough to cover the original cost of acquisition plus the conversion costs, then you've got the asset for free. You've got all your initial capital back, and you can do the next one. because that's the only way you can do one deal after another. So you've got to look at how fast you move you've got some funds, you put it in a deal, and then how fast can you pull it out and shove it into the next one. And how many of those can you do in this golden period of, say, between 2020 and 2023? And that's going to kind of make your fortune, if you like, for the rest of your life, really. It's just one of those times.
So would you advise it's a good strategy personally, or what do you think? I mean, do you advise it? Would you advise someone to sort of do that kind of strategy to sort of build funds or for whatever reason?
Well, as I said, the strategy I advise is to find under market, if you can. But then you've also got to remember that the permitted development improvement strategy sometimes offers so much uplift that you don't care paying market value or even 10% more. I have bought property for paying more than market value just to get the vendor to sell to me, because what I'm doing with it is worth paying that 10% more. Yeah? So, because what I believe in markets, it's not what I believe, it's just true, really. I mean, the market is cyclic. There are times when you get period of rampant growth and it's growing double-digit inflation every year. And that's when you can do all this. Do you remember the property ladder program with Sarah Beanie? When they show that in the boom time, you know, I used to do some work. I used to be an advisor on that show. The researchers used to sort of ring me up and they would talk through scenarios, and you know, Sarah gets a script and all of that sort of stuff. But what they do, the researchers go out to find the biggest plonkers they can and put them on telly. If you were to go on that show, what you should say is, "Oh, Sarah, you're saying that? Okay, great, I'll do it." But that makes boring TV. They want the people that says, Sarah says do this, and they go along and do that, right? So you get these plonkers, they ignore what she says, they do silly stuff, it's boom time, it takes twice as long to do the project, and guess what? When they do the financials at the end, they make money, but it's because of the rising market. They could have bought the property, left it empty, and it would have still, kept it for 2 years, it would have still risen in goddamn value. Didn't they need to do anything to it? You know, now we don't have that. If you make a cock up, it ain't gonna work. Because you know, you don't have that cushion of rising market. So you've got to create that value. So your assumption should be that I'm buying this for 100 grand, it might be worth 110 next year. So what am I going to do to bat this out the park? By converting part of it to residential or whatever, I'm uplifting the value by so much that even if the uplifted value of the flat has dropped by 10%, it's still doubling the value of the real estate that I've bought in the first place. Does that make sense? Yeah? So you're just, you're working on a strategy or a technique which really is, I actually do not understand any other reason for going out and buying property over the next few years. If you feel the market is going to be subdued, you know, because what's the point in owning rental property? Yeah, it's a lot of headache, quite frankly. Your returns are from capital gain. Yes, there is yield. Commercial property buy-to-let is far easier than residential buy-to-let. But if you look at buy-to-let, residential buy-to-let investors, they've made most of their return from capital gain. And if it ain't going to happen for the next 5 years, then buy-to-let in 5 years' time. Yeah, when the capital appreciates. The reason for buying now is you're going to create value today in today's market by doing a value uplift. So that has to dictate whatever you buy. Does that make sense? I mean, I don't know whether I've kind of explained it. I know I'm a bit tunnel visioned in this, but I really don't see what else is worth doing over the next few years. If you buy something off plan, if you buy something that's a ready-made buy-to-let, the chances are the value of that property may fall over the next 2 or 3 years. So why do it now? If you're interested in a ready-made residential buy-to-let, do it in 2 or 3 years' time. You know, commercial buy-to-let. What I'm a big, I don't really like buying a commercial property with a tenant already there and there's nothing that can be done to it. There's got to be something that you can do to the property to value uplift. So I love things like properties where the existing lease is coming to an end and perhaps it can be repurposed in some way, or perhaps it's being rented at a low rent and there's opportunity to increase rent, or perhaps there's opportunity for part residential conversion or repurposing. So when you're looking at a commercial property to buy, who's the tenant now, and is there anything better that property can be? I mean, we've bought a bank building in Stoke Newington recently, and it's currently let to HSBC. Now I know at the end of the lease, what are banks doing? They're packing up. They're unlikely to renew their lease. They're not going to renew their lease, I know that. But the issue is, what can that building be repurposed to? And again, with the permitted development opportunity, because, you know, there's another interesting tidbit here. What we talked about in the earlier presentation was permitted development to put 2 flats above a shop. So if you buy a double-fronted shop, so you know, like you buy a shop and it occupies 2 house numbers, it's a double-fronted shop. That actually gives you the right to build 4 flats above those shops. So, but if it's a office space above that shop, there is no limit to the amount of units you can create, because it's B1 usage, if that makes sense, yeah? So this property, this bank building, was bought at auction. Now most people, and everyone knew about it, but most people were thinking, yeah, because I went to the auction viewing, I heard people chat and everything, most people were thinking, this is a double-fronted shop, you can do 2 flats above each, you can build 4 flats, yeah? But I'm thinking, well, no, it's not, because the space above the bank, what has it been used by? It was used as office space by the bank. So that comes under B1 usage. And that means that you can convert it into as many flats as you like. And because Stoke Newington is a trendy London area, it's well connected, it's an area where micro apartments will work, under permitted development, we can convert that space into 8 micro apartments. So suddenly, other people are looking at it from one point of view. We are able to outbid people at auction, pay whatever it takes to get it, because they are not working on the spreadsheet of my strategy. Yeah, and the thing I love about commercial property is the deals are hidden in plain sight, they're all there. 50% of my stuff is bought from auction, which everyone has got the access to the catalogues and the information, but not everyone knows how to skin the cat. So if you're bidding for a property against me at auction, we've all got the common knowledge and everything like that. But if my plan is better than your plan, then I can afford to outbid you. Yeah? It's as simple as that. So it's about having the best plan for a commercial site. And that's really about knowledge. You have to have that sort of knowledge. And, you know, the stuff that we've talked about today, you will find that, you know, commercial agents are, you know, not that. I mean, I run a commercial property weekend workshop. I only do 2 a year, and we spend a whole weekend going through these strategies. At the last workshop, I had 4 chartered surveyors, and one of the guys had been doing this for 20 years. He says, I know all this from a technical point of view, but I haven't put it together from the entrepreneur's point of view. So there are people, you know, that know about it but don't know about it, if you see what I mean. The interesting, I mentioned this, I mean, this is laughable. The property that Kieran bought at auction, not only was it bought from auction, but do you know who the tenant was in there? They were a firm of chartered surveyors. And we spoke to them afterwards, and they said, yeah, we knew about this PD, but they hadn't quite joined up all the dots they know about it from a technical, Wix and all of that point of view, but not from an entrepreneur point of view. So it sounds laughable that this cracking deal, public auction, and a firm of chartered commercial surveyors were in there as the tenant, and no one pieced together the pieces. So to think that this all is common knowledge is just not. I mean, you guys have already got more snippets really from being here today than most people will have who are attending these auctions. So that's why I also find that once you know all this stuff, actually finding these deals at auction isn't that complicated, because people are looking at the vanilla, and what I encourage people to look at is the pistachio mango with chocolate flakes on top and all of that sort of stuff. And when you start to do all of that, it gets very interesting and it's fun. And you know, very easy to finance. I mean, I think one of the questions that people ask a lot is how do you fund these deals? The hardest deal to fund in commercial sense is a basic vanilla deal. So you go to auction, a property is let to Costa Coffee and it's being sold on a 5% yield. There's no development potential, there's nothing you can do with it. The buyer for that will be a cash investor, because if you have cash, what are you going to do with it? You're earning nothing. So if you buy a property that's let to Costa Coffee for 20 years, you know it's not going to they're not going to move out, it's not going to get replaced by internet trading and all of that. It's a good home for your cash. Yeah? But for people like us, we're not interested in good homes for our money as such. You're looking at turning cash through development projects, and you're looking at making products, commercial products if you like, to sell to those cash-rich investors at the end of the day. Now, those ready-baked kind of products are harder to finance. Propositions like this are very, very straightforward. Because it's simply about getting a bridging loan for the initial purchase, and the equity will come from private investors and the like, other people's pensions. You know, the main reason I do my training programs is that I have people come on my training programs. I also run a mastermind program where we do all the stuff for a year, and they all go around doing the strategies I teach them, and then we invest in them. And everything's a known quantity then. It's a very, very safe way of, for me, leverage in deals all around the country and doing some interesting stuff. So that works really, really well. And investors are not difficult to find when you've got a cracking deal. When you've got a cracking deal and you can articulate the vision and the uplift in 5 minutes, anyone that's looking to invest, and if you're bankable as a person, of course, anyone will dive in. It's the duff deals that are hard to fund. I mean, normally people are fighting them off. I mean, I wanted to back Kieran's deal fully, but she'd already committed to it was actually, she learnt this strategy on a workshop I ran a year and a half ago, and her investor came on the workshop and sat next to her, but she's too busy in her job to do to get involved in sourcing and all of that. She's an accountant, she likes the job and all of that. So she understood the strategy because she was on the workshop. She met Kieran on it and said, right, you know, I'll come in on you. So when you've got a good deal, you know, you're fighting off investors to kind of come in on it because everyone can see it. It doesn't become that complicated. Okay, we're out of time. I hope that was informative. Do connect on Facebook and whatever, and get on the YouTube because there's tons of stuff. If you enjoyed this video, hit the like button. If you're not a subscriber, what are you waiting for? Subscribe, hit the bell icon. As soon as we upload, we'll let you know. And enjoy these. They're all dedicated to helping you be more successful in property. Happy investing!